Good day to all. This will be our discussions involving government grants. Our related standard for this is PAS 20 or Philippine Accounting Standards number 20, and that is accounting for government grants and disclosure of government assistance. That is the complete title. This will be any grant, could be cash or non-cash asset provided by the government. So how do we account for that? And disclosures only for government assistance, which are normally services provided by the government. For learning objectives or outcomes of this chapter, we should be able to explain the recognition and measurement for government grants. When do we recognize? When do we journalize? What are the requirements for such recognition, recording, or journalizing of government grants? And of course, for journalizing that is closely related to measurement. After that, explain the presentation of government grants in the financial statements. How do we present or place government grants on our financial statements? Normally, the statement of comprehensive income and the statement of financial position. So, for definitions, government grants are assistances or assistance by government in the form of transfers of resources, as said, could be cash or non-cash assets, to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. Normally, when the government provides or transfers resources to a certain business, there would be some conditions attached. The conditions attached could be varying on situations, meaning it's going to be a case-to-case basis. They exclude those forms of government assistance which cannot reasonably have a value. So take note that government grants have amounts that can be stated or measured. For services or assistance, if they do not have reasonably a value, then we do not account them as government grants. As said a while ago, they will be disclosed in the notes to financial statements. So to continue, transactions with government, which cannot be distinguished from the normal trading transactions of the entity, because some services cannot be physically and properly segregated from the others. If not physical, so proper segregation cannot be done. Or we cannot be specific to the entity, because for a government grant, it should be a financial item that is specific to a certain entity. Other terms for government grants include subsidies, subventions, or premiums. And we can, of course, have the word government prior in order to differentiate it from the other items or grants, subsidies, subventions, or premiums. Then, as said, there are items that are basically not government grants on top of government assistance, which is also a separate classification, but there are also even services that are clearly not government grants and government assistance, like tax benefits provided by the government. That's already under taxation, so it's not something unique or specific to a certain entity or provided to an entity. Free technical or marketing advice, it's for free, no value there. Provision of guarantees wherein the government could be shouldering certain debts. So in that case, we are not yet certain if this is really of a financial value or not. Government procurement policy that is responsible for a portion of the entity sales. If we say procurement, this is the purchase. So government is partnering with a certain organization, and then, for example, the government is being a partner with the entity, so there is some sort of policy, and then that would result to portion, if not significant portion of the entity sales the business. So in that case, that's part of the purchasing contract or the bidding process and the purchasing contract later. Therefore, that's not government grant. And finally, public improvements that benefit the entire community, wherein it's very clear here, it's for the public. It's not specific to the entity. Again, for a government grant to be one, it should be that the benefit in the form of cash or non-cash assets should be specific to a certain business or entity. Now, for recognition, that is for our journalizing and recording government grants, including non-monetary grants at fair value. So not necessarily in money, could be in other non-cash assets like land, building, etc., shall not be recognized until there is reasonable assurance that A, the entity will comply with the conditions attaching to them and that the grants will be received. So these are the two requirements that should be taken into before an entity should recognize any government grant. Then classifications of the government grants according to attached condition. So the grants could be related to assets, wherein primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Hence the term related to assets. So whatever amount is to be given, the condition is that the entity should acquire certain assets. And then grants related to income other than those related to assets. So it could be other conditions attached, like money is given in order to finance or support certain calamities. So initial measurement. For monetary grants, they are to be measured at the following. So amount of cash received, the amount, or if it is still receivable, the fair value of the amount under IAS 39. And then we also have, of course, our IFRS 9 for financial instruments, or carrying amount of loan payable to government for which repayment is forgiven. In this case, supposedly there is an amount to be paid by the government. It is forgiven, therefore, that sort of income on the part of the recipient or the borrower. Then discount on loan payable to government at a below market rate of interest. This is also an interesting government grant. So let's say the face value is 2 million and we are given the discount. So let's say in the form of, instead of 2 million face value, we will be receiving like 2.5 million. So the 500,000 is a sort of government grant in our case. Next, non-monetary grants. For example, land and other resources are measured at the fair value. This is, of course, a basic concept for non-cash assets, wherein they have to be recorded at fair values. And as an alternative or another option, it can be a nominal amount or any other amount if no fair value, or zero, plus direct costs incurred in preparing the asset for its intended use, which is something that is secondary because under IFRS 13, fair value measurement, there is a rebuttable presumption, although not absolute, that we can determine the fair value of non-monetary assets. So in that case, that's the reason that there's really fair value to consider. But just in case, there's an alternative. Then for accounting for government grants, we have to take note of the matching concept. This is the main concept in accounting for government grants. We recognize income in the government grant as the entity recognizes expense that is related to the cost for which the grant is intended to compensate. Meaning to say, there's an expense that is there, like losses from calamities, and then the government will provide income in order to match, in order to compensate, of course, for that particular expense. So at least it can help alleviate that particular loss, if not, let's say 100% offset or cover. So at least it can compensate a portion of that loss, for example, or even any other expenses. Then when we present government grants related to assets, on the statement of financial position, there are actually two options, either gross or net. For the gross presentation, it has to be presented as a deferred income or liability, in which initially that's a liability, but it will be earned along the way. So for example, if that is a grant related to a non-depreciable asset, so of course it will also be based, let's say, on the number of years that the grant will be usable or will be provided to a certain entity, and that can be used in certain number of years for the operations. For the depreciable asset, which is the most common, or I would say more common if we compare depreciable versus non-depreciable, wherein whatever is the depreciation method for the depreciable asset, and then number of years, because that is very important, especially for depreciation methods of factors of time or passage of time. So we just simply use straight line method in order to get the income or the income portion of the deferred income. So there is a transfer from liability to income. And how much is that? That will be the amount of the grant divided by the number of years. For net presentation, the grant is deducted when computing for the carrying amount of the asset. So whatever is the carrying amount, you are going to net that with the grant or vice versa. Then what about if related to income? In this case, we have two options. So it's either gross presentation or net presentation. For gross presentation, we are going to present as part of other income on our statement of comprehensive income, formerly known as income statement, after gross profit or gross income, for example, and other income. So we will put that there as part of other income. And then other income, the details will be disclosed in the notes to financial statements with our income, for example, coming from the government grant that is automatic or as a whole, especially if it is related to expense that is to be recorded immediately, like the casualty losses. So income immediately because the loss or the expense is there. But then, for example, if it is related to a depreciable asset, remember the depreciation expenses will be all throughout the years of the life of that PPE. So in that case, we have to recognize the grant in relation to that time period. So in other words, what will be shown on statement of comprehensive income under other income section will only be the transfer. So from the deferred income to income, because this is income statement, or again, now known as statement of comprehensive income. Another one is net presentation, wherein the grant is deducted in reporting the related expense. So expense net with the income coming from the grant. Normally for the two, a while ago in relation to asset or related to asset for presentation or assets and now to income, we use gross presentation in order to show the details, but it doesn't mean that net presentation is wrong. And finally, what about repayment of government grants? Now, it's possible that a government grant that becomes repayable. So example, we did not follow the conditions attached to our government grants. So we violated, in other words, or we breached the terms of the contract. Therefore, the grant becomes repayable. We have to refund that or return to the corresponding government agency or the government as a whole. In that case, you have to account for the change as a change in accounting estimate, wherein we have to account for it prospectively, meaning to say in current and future periods. So what happened in the past remains or stays in the past. We just have to incorporate the change in the present and make the necessary adjustments. So this would result normally to a loss because supposedly we have an income and then we violated the contract. So there is a loss for the repayment of the grant. That is under PAS 8, our accounting standard for accounting policies, changes in accounting estimates, and errors. All right, so this is the end of our discussion of theories involving our government grants. Hopefully you got something from the session. Thank you very much and God bless.